Hi there, I'm Wilhelm Hertzog, one of the three portfolio managers here at RECM, responsible for managing balanced equity and global funds. And I'll be chatting to you briefly about fund returns over the past 6 months to a year, and how our funds are currently positioned, where we're finding value, how we see things going forward. We covered most of this in our most recent publication of Review. For more detail, I'd like to refer you to that publication available on our website. So starting off with balanced funds, over the past 6 months to a year, our balanced funds have delivered very good returns compared to the benchmarks, both in absolute terms and also relative to peers and relative to other benchmarks. This has to a large part been driven by substantial exposure to offshore equity, where we've had the ability to do so. We've taken substantial money offshore for our clients over the past 2 years or so. I guess late 2010, early 2011 was a time when the rand was quite expensive and there was good value to be found offshore, and we managed to take that opportunity, and it's done very well for our clients. Local equities also did well, and the South African stocks we own in balanced funds performed nicely in absolute terms over the past year or so. Our exposure to fixed income has consciously been limited over the past number of years, and in recent months that has served the fund well. Fixed income didn't deliver good returns over the past 6 months to a year, and the fund's limited exposure to that asset class served the fund well. Looking at the current positioning, we're seeing that the funds overall are trading at about, or priced at about 80 cents in the rand, which is attractive value, not fantastic, but it's good value, and it should bode well for solid returns in future. It's not something which concerns us, and we're quite happy with the status quo. We're finding good value in some sectors of the South African market, but finding other sectors of the South African market very expensive. And in that vein, moving on to our South African equity fund, the South African equity fund has delivered good absolute returns over the past 6 months to a year. It's up nicely, but it's lagged the South African all-share index. This is a continuation of a trend which we've seen for, I guess, about 2 or 3 years now, where the South African market has been driven upwards by expensive large cap industrial shares. We own none of these shares in our South African equity funds, and neither in our balanced funds or elsewhere for that matter. And this cheap, very attractively priced assets that we do own in the South African equity space has been mainly in the resources sector, and those assets have continued to lag the market. Negativity around those assets have yet to abate. And in this type of environment, those asset prices have really gone nowhere, despite the fact that we think these assets are actually of good quality in many instances. I'm thinking specifically of the platinum miners here, and the fact that they are priced so cheaply. Our equity funds positioning today is still very much in the South African resources space. Compared to the all-share index, our allocation to resources is much higher. Our allocation to industrials is far lower, very limited exposure to industrials, and some exposure to financials, which we think is priced more reasonably than the industrial sector in South Africa in general, but far from very attractive. In terms of pricing of the fund and discount to fair value, we see the fund overall priced at about 80 cents in the rand, which, as for our balanced funds, represents good value. The fact that the South African market is expensive on an overall level is mainly to do with the fact that large cap industrial shares are quite expensive. And as I said, the market is in fact quite bifurcated, in that we're finding at the top end there's very expensive assets, and at the bottom end there are actually very attractively priced assets. For instance, in the platinum mining sector, which is something we've spoken about on numerous occasions in the past. Moving on to our global fund. Global fund did have a fantastic year in 2013. This was driven by large exposure to Europe. So despite the fact that our global fund held about 15% cash on average over the past year, the fund outperformed its MSCI World benchmark. And as I said, this is because over the past 2 years, Europe offered phenomenal value. The MSCI World is dominated by the US as a geographical, or as a country. And the US actually is fairly expensive and has been so for much of the past year or two. So it's quite surprising that in an environment where an index which is not cheap on an overall level increases strongly, as the MSCI World did in 2013, that our funds outperform. And this is very different to what we saw in South Africa, and it's because the international markets are so much more diversified. There's a far greater opportunity set, and we were able to exploit this and go into Europe in a meaningful way over the past 2 years. And that has really given great returns for the global fund over the last year or so. Currently, we're finding it more difficult to buy value globally. As I said, Europe has re-rated substantially. The US is reasonably expensive, we would say. And we're struggling more and more to find good value. The recent sell-off in emerging markets has certainly become interesting to us, but emerging markets are still far from screaming bargains, we would say. Some markets do look interesting, and we're scratching around and coming up with some interesting things, but it's not a case of Europe 2 years ago. We're still a long way from that. In terms of the positioning going forward, pricing also priced at about 80% of fair value. Again, decent value, not spectacularly cheap, but should bode well for our ability to deliver index-beating returns going forward. So in summary, the last year and 6 months have been very good for RECM Funds and for our clients. We are happy with how the funds are positioned. We have full confidence that our value philosophy and our ability to implement the philosophy through a sensible process will bode well for our clients going forward. Thank you very much for your support.